Hey guys, you're listening to the Tasha Labs podcast, and today I want to talk about a couple things. First of all, I want to talk about the market and how the macro situation is changing or not changing and how that's affecting the market. We had some news coming out this week. We had the Fomc meeting, obviously, on Wednesday, and we also had Q2 GDP number of the United States that came out negative from quarter-on-quarter growth perspective, and that got a bunch of people saying on Twitter, oh my god, we are in a recession, the Fed's going to pivot, so on and so forth, or they're driving the economy to the ground. So we're going to discuss that, right? And specific related to why the market is up and are we seeing the end of the bear market, so to speak? And secondly, I also want to talk about some of the questions I got on a recent article that I wrote that is on 35 Web3 business ideas that could disrupt traditional industries. So basically, I did this thought experiment. I put down on paper 35 ideas of, I look at basically the list of large companies in the world in NASDAQ and S&P 500. And I thought about how those companies were run alternatively on a Web3 model. And by Web3 model, what I mean is to use some kind of, to leverage the tokenization and the Internet of Values and the blockchain technology, or push decentralization of the business model further along. So I did that and got a bunch of trolls on Twitter telling me, oh, these are terrible ideas. You're an idiot. Yeah, I know. So I'm not saying those are brilliant ideas, but it's a thought experiment, right? To get you to think about what is really the value added of Web3 or tokenization business model, and how potentially traditional business can be transformed leveraging the new business models. And devil's in the details. You can tell me, oh, these are all shitty ideas because this would not work, that would not work. Yeah, I know. But this is really, something that got me thinking, and I think got a lot of people thinking. And I got some interesting questions on that, so we can talk about that. And if we have time, last time I said I'm going to talk about investment methodology and investment related to, especially investment related to your personality. Which I think is quite important, because I realize by, observing a lot of people in general, a lot of traders or investors, all types of investors make money in the market and all types of investors lose money. You can make money as a day trader. You can make money by hodling. You can make money by swing trading. You can make money by investing in very, very early stage, high risk companies, or you can make money by investing in distressed assets. There are all sorts of ways to make money, and people do that all day long. But in every of these categories, the majority of people do not make money. So when you think about this, it's less about what's the specific methodology that you follow. It's not like, hodling is definitely better than trading, or day trading is better than swing, or, none of those are in absolute terms better or worse. It's, I think it all comes down to how you execute. And the quality of your execution, I think, has a lot to do with your personality. So you need to pick the methodology or method that really fits your personality, and that gives you a natural advantage, I would say, if the way that you invest naturally aligns with the way that you think and operate in general in life. So I actually recently picked up a practice which is I should have been doing this earlier, but I just picked it up recently and try to do it more in a more disciplined way, which I want to talk about it if we have time. That really helped me. So, but first of all, let's look at the macro. So Q2 GDP down on a Q&Q basis. So that got a lot of people saying, okay, we have two consecutive downtrend in the GDP level, this is a technical recession. And when the Fed says, "Oh, this is not a recession," and people are, protesting that, "Oh, you're changing the definition of recession because you just don't want to, acknowledge that you're wrong." But all those things. But seriously, when you actually look at data, right? Yes, GDP down on the Q&Q basis for the second quarter in a row. But what happened is you actually look at the breakdown of the GDP. So there are several things of why I think, yes, the economy is still slowing down, but we're not in a recessionary situation yet. So there are several points I want to make, okay? First of all, if you actually look at the breakdown of the data, so the GDP growth, you break that down into consumption, investment, inventory changes, and government consumption and investment, and net exports. Those are the demand side components of GDP, right? So if you look at how these components contributing to this negative growth in Q2, it's mostly negative changes in business inventories. So businesses try to accumulate more inventory. So over COVID period, and we are still having lots of supply chain problems. So people kind of stock up. Business need to stock up inventories so that to accommodate this increased uncertainty in supply chain, and that's one of the reasons, right? But so now you see inventory drawdown. That is actually the biggest driver of the Q2 GDP negative growth. But if you look at all the other components, net exports is up, which is interesting because dollar has been appreciating, right? So even in a dollar appreciating environment, you had net exports recovering. I find that interesting, which tells you that export growth is actually quite strong. By the way, all of these are on real terms, okay? Not so basically already taken out the price impact. And consumption is still going up. Real consumption growth is going up, and it's positive. So the growth rate is slowing down. So like we talked about before, consumption is the biggest driver of the U.S. economy because it's a super consumer-oriented economy. So really, the health of the economy, where the health is, you need to look at the biggest part is the consumption. So consumption growth is slowing, but it's still positive. So we're definitely in a slowing down economy, which is what the tightening of monetary policy wants to achieve, right? So the Fed wants people to go buy less stuff, because if you buy more stuff, you drive up the price. You add up to the demand pressure of inflation. So the monetary policy is doing what it should. Okay, if you believe this consumption slowdown is actually related to the monetary policy, I think maybe there some part is related to it, okay, but maybe not all. So and you also on the investment side, yes, you see some like a real estate investment. You're seeing negative growth in residential investment and non-residential investments. So these are, I think, contributed to like a minus 0.7 or something to the Q2 GDP growth. So yeah, so these are slowing down because we have interest rates going up. We have mortgage rates going up, and though it's stabilized more recently. So real estate is the sentiment about real estate is quite negative right now, right? So it's unsurprising that investments in those are going down, which is also what monetary policy tightening is trying to accomplish. So that's the second factor, or are we on the third? I lose track. And the next factor is if you look at the gross national product, which is like a parallel concept to the GDP. So GDP is national gross domestic product, right? So just to refresh your Econ 101, GNP, what is gross national product, is GDP plus the income that the citizens of a country, so the citizens of the United States, earned, whether it's domestically or abroad, or in this case, if it's add on to the GDP, it's from abroad, minus the income that earned in the United States by foreigners. So it's really, so that's why it's called the gross national product or gross national income. It's like similar, right? So if you look at this measure, it's still holding up pretty well. And you look at most of the previous official recession periods, you have GDP and GNP both going down to a negative territory for a period of time. So GNP is still holding pretty well, so makes you wonder what's up, right? So this is related to, if you see the negative growth in GDP, it's mostly driven by inventory drawdown. So the bottom line is, I don't think this is pretty far still from any kind of panic mode for the Fed when they're saying, oh my God, economy is contracting too fast, we're going to do something, we need to revert policy. I think we're still pretty far from that, right? And when people are saying, oh, we're in a recession, when they're pounding the table saying, oh, the Fed needs to pivot, the Fed is bad, is driving the economy to the ground, you need to check who's talking, okay? So sometimes I see people who are saying that tend to be like who have a large stake of investments in tech. In other words, high beta, high risk investments in that kind of asset classes that are super affected, that are most affected by Fed policy, right? So there is an incentive for those investors, or there is I'm not saying like people are deliberate doing this, but everybody is biased, right? You are biased by your bag. It's just like even on the unconscious level, even if you are not really trying to consciously be biased, we are all biased. And when your assets are all in the tech stocks and with revenues, real profits coming in 20 years down the road, those kind of assets tend to be, and also crypto too, tend to be most affected by any kind of rate changes, interest rate changes. So I think those people are naturally biased, okay, towards saying, oh, rate hike is too much, you're hiking too much, you're doing damage, so on and so forth. But in the short term, we've got a pretty strong rebound since so the bottom, the current I would say local bottom is middle of June, and then we had a pretty confirmed uptrend starting in the beginning of July for both crypto and for equity markets. And also after this Wednesday's FOMC meeting where Fed announced they're going to hike another 75 basis points, the market went up, right? So why is that? So this is so I was looking at the just market data on Wednesday. It's actually the market started bouncing up right from the get-go on the trading day on Wednesday, like way before the 2:30 p.m. press conference, or was it 2 p.m. on Wednesday? So I think there are two folds of why the market is up after the FOMC meeting, which hiked interest rate, and so theoretically it's bad for the market, right? But there are two things. One of them is it's actually we're in, because there's so much uncertainty in the environment right now. Any news that can remove a piece of uncertainty for the market is going to be bullish. So because the 75 basis point, at least bullish in the short term, and 75 basis points were already widely expected by the market, and the uncertainty actually was were they going to hike 75 or 100 basis points, right? So a lot of people start saying, oh, we are going to see 100 in July because inflation is not coming down. So if the expectation is to say, okay, we're not sure if it's 75 or 100, but it's pretty possible it's 100, and you have that uncertainty, and then it ended up being only 75, then, everybody, exhales, right? Give a sign of relief. So it's like the market expectation is you have to look at what is how the news compares relative to expectations, not the absolute terms of the news. So we had a remove of that uncertainty, and that's the first piece. And the second piece is, a lot of people watch the market all day long and try to discern any kind of predictable patterns from the market, right? People watch the market, humans watch the market, and machines watch the market to practice pattern recognition all day, every day. So a kind of mini pattern you notice it from the past, from the recent FOMC meeting is actually after each of the FOMC meeting, you had a mini bounce of the market. As far as I remember the past two. It happened in the past two. I don't remember exactly what happened in the December meeting, but in the March meeting, in the May meeting, you both had kind of a bounce after the Fed meeting, which is somewhat, part of it at least is related to the removal of uncertainty part that I just mentioned, right? So and the March bounce was pretty significant. So now you have all these things happened a few times in a row, and the market starts to pattern recognize, right? And you have people started thinking, okay, so we had these recent patterns of market going up after the FOMC meeting, so we got prepared for a bounce after the FOMC meeting for this pattern to continue, right? So you have already bunch of people expecting that to happen, and they're positioned for that to happen, and like even before the FOMC meeting, because the way to make money, at least one way to make money in the market, is you got to be earlier than other people, right? So people try to be earlier or to front run other participants. If they're thinking, okay, after the FOMC meeting, very likely market is going to be up, then I should be positioning now, right? I should be early. So I think that's why you see like a few hours, like almost a day before the FOMC meeting, market started going up. Because when you have more people positioning like that, you change the supply demand balance of the market. So that's like becomes a self-fulfilling prophecy, right? So I think that's why, at least the two factors that I can think of. I'm sure there are other factors why you're seeing, the recently you're seeing like market bounces after each of these FOMC meetings. So, but then we've had quite a bounce since, as we mentioned, end of June, beginning of July, right? So, and the bounce is quite strong so far in both equity market and in crypto market. So the question is, are we seeing the end of the bear market? To me, my baseline answer is it hasn't changed. Nothing has changed. And this is not the end. Why am I saying this is not the end? Because I don't, again, it related to the point we talked about at the beginning. I do not see a panic mode for the fact saying, oh, economy is bad enough, we got to pivot. I don't think we are nearly there yet. So micro environment has not changed. We're still in a tightening cycle. In the middle of the tightening cycle, Fed balance sheet going down, rate is going up. That bigger environment is not changing. Okay, so all the things that contribute, all the macro factors that contribute to a bear market, they're still here. So why we're seeing a bounce? Well, again, market is supply and demand. If you got like a market is oversold to a really, really drastic degree, I think at the end of June, I forgot, was it end of June or sometime like definitely in the past month. Okay, the percentage of stocks on the U.S. stock market that is above the 40-day or 30-day, I forgot, some kind of intermediate, like a medium-term measure, above the 40-day moving average was like dropped to below 15%, and like really, really low if you compare to the historical average. Okay, so any time you have like extreme despair, extreme supply demand imbalance kind of situation, like market is oversold, then you can be due for a bounce, and once you start bouncing, you kind of wash out a bunch of shorts in the market, and then that kind of creates a upward reflexive cycle, at least for a time period, right? So, but if you look at the bigger picture of things, okay. So in one of the previous episodes, I talked about like, I think right now we're going through the .com burst of the crypto market, right? So if you compare the actual .com burst, where are we right now? So let me find the actual .com. Gosh, I have too many tabs open on my computer right now, so it's hard to. All right, just bear with me for a sec, okay? Let me try to find this. Nasdaq. What happened to Nasdaq? Because I'm trying to find what happened to Nasdaq after the .com. So basically, you had .com bursted in like a late 2000. Okay. And then the market dropped dramatically, and then you had a bounce, and you had a pretty big bounce. How much is it? Let's see. All right, yes. Now I found it. So you had market drop, and then a bounce from October 2001, October 2001 to December 2001. So there's like 3 months. Okay, you had a bounce of 3 months after the .com crash. Of the magnitude of 45%. Nasdaq 100 index went up over that 3 month period by 45%. Okay, so that's a pretty significant bounce. So is that the end of the bear market? Turns out no. And part of the reason is remember last time I talked about the macro environment was also, at the end of the .com cycle, we went into a tightening macro cycle as well. So not exactly identical to what we are experiencing right now, obviously, but just to give you some reference point from history, right? And then after December, market went down again, and then it goes down and down and down and down and down, and the bottom, the actual market bottom, didn't hit until October of 2002, which is like 2 years after the crash started. Okay, so I'm not saying we're gonna see like 2 years of bear market. I don't know. I don't know anything about these specific timings to be able to predict so far advance out. Okay, but just give you some historical reference. So you can say, okay, time is speeding up in general, but on the other hand, the macro environment is more severe. This tightening cycle is like the biggest one we had is since GFC, since the global financial crisis, right? So my point is, you can see a bounce, and a bounce can last a while, and you better take advantage of it. I would, I've been in like trading in the market the past month. I've made some money, but I would not be like, I would not feel comfortable to be fully invested right now, and I watch the market pretty closely. So that's my way to deal with it. You may have, different people will have different ways to deal with it. Depends on your personality, right? Again, some people, they just don't want to bother. They have a long-term conviction. They're gonna hodl all the way through. Some people, they trade in and out. Again, all methodologies can make you money, but devil's in the details. It's all about the execution. Hey, so that's the macro part. So let's look at the questions. So these are like questions on this article, which is like 35 Web3 business ideas that apply to traditional brands. I basically went through a list of like traditional, like large companies, not traditional, some of them like Amazon, Netflix, they are Web2 companies, right? So I went through those, and I, brainstormed ideas of how, they can use a kind of Web3 model. So let's look at some questions. First one from Jay. You don't seem to understand securities regulation. Your description of a utility token is a security. The value of the utility it grants in the future depends on the effort and execution of the issuing organization. That is a security. Okay. So this is related to the famous Howey test, right? In the U.S., that is criterion to evaluate, to assess whether some kind of financial product is a security, right? So the Howey test is that so basically for something to be qualified as a security, it needs to be qualified as an investment contract. So what is an investment contract? Investment contract, it needs to be there has to be several conditions met, right? There needs to be a investment of money, right? You exchange money for some like a stock certificate, for example. So it needs to be in a common enterprise. It needs to be so you are putting money in with the expectation that you will profit. That's the third thing. And also this profit needs to be derived from the effort of other people. In most cases, that's the entity, the company, the enterprise, right? So by these criteria, our crypto utility tokens count as investment contracts? I don't think so, right? So obviously, this is not legal advice. I'm not a lawyer. I'm just talking common sense, right? You judge for yourself whether this is true or not. Does that make sense? Or you can go ask a lawyer. So first of all, a utility token, right? So let's say last time I used the example of an airline miles. I'm gonna still use that example, even though that may not be the best example, because I don't see airlines want to have incentive to convert their miles into Web3 tokens right now. Yeah. So, but this is like a well-known thing that most people know. So let's use that as an example. So why airline miles are not security? Because it's not an investment contract. Why is it not an investment contract? Because you're not putting any money to invest in airline miles. It's being given to you based on your activity, based on the user's activity, right? It's not like you go to invest in it. It's not like your friend is starting a company and he asks you to invest and you put some money in exchange for a share of the company. So airline miles, which all of these like apply to utility tokens as well, right? So airline miles, airlines give to you based on your record of your user activity. In this case, particular case, is you are flying more, so you get miles. So these are basically airdropped to you right? Without any direct exchange of money. So already the first term of investment contract does not fulfill. And also, are you are you holding the miles with the expectation of profiting from your miles? No. The miles allow you to, in the future, apply towards future air ticket purchases, right? So if the airlines are to tokenize their miles in the form of utility tokens, the same thing, right? You get airdropped utility tokens because of according to your usage, right? Either you're a power user or you refer users or any kind of activities that the company want to incentivize. And then the utility part is that you can use that token towards some kind of future usage. For example, redeem products and services from that enterprise or from that project. So that's what utility tokens means, okay? So just like I think just like very obviously these criteria, like just if our definitions of how, or our concept of how utility tokens will work, they do not qualify as investment contracts. Okay. Now there may be there are obviously a big reason why utility tokens will be more attractive to end users compared to airline miles is because they have secondary market utility. You can trade on the secondary market, right? But that's a different thing. It's not like a secondary market trading. You have commodities traded on the secondary market. You can trade corn, you can trade soybeans, you can trade anything on the secondary market. You can trade like a Super Mario, the cards on the secondary market. It's not just because something has a secondary market does not qualify that as a security, okay? When it does not fulfill these basic criteria as an investment contract. Now, however, if you are issuing your token in some form of like ICO or IDO, which was like a very popular ICO, was very popular in 2017, and we had like some initial DEX offering, which is IDO, which like came out more in this past cycle, right? If you're doing those, then I think it becomes a investment contract, because that initial token offering is actually, people are investing money in exchange for a token with the expectation that they will profit from your project's future activities. So, but I think so that would depend on how these tokens are issued and how they're run, right? So, but if I think utility tokens, in the way that I see how it work, they should not be qualified as securities. And also, the securities regulations are, I think for sure they're going to change. And how soon they're going to change, I don't know. Probably slower than people expect, because these changes also always happen slowly. But if you look at the, the draft crypto law that came out also, is that last month? Like by 2 U.S. congressmen, they are proposing to carve out a kind of a specialized security laws, specifically applying to digital assets, which is, applied differently compared to the more traditional like investment products, and that kind of loosen the criteria of what qualifies as securities more for digital products. I'm not saying that's going to pass. I will be very surprised if it's just like a smooth sailing and it gets indoctrinated into the law very fast. But I expect some kind of changes to happen in the future. Okay, that's that. And then next question from Day NFT. The most important question to ask is, why does this project need a token? Many times the answer is because their business model is so weak that the only way to get any funding was to create their own money printer, aka token. So I'm very sympathetic to this sentiment. Okay, so I think he's talking about, because I was mentioning, business, like most Web3 projects, they don't really have a business model. They're just like hiding behind the reflexivity of tokens, and that drives up some kind of pseudo adoption, which is not real. So I'm actually pretty, sympathetic to this comment, because I think in most cases, all right, if a project, so we were talking about projects that do these ICO or IDO. Basically, you have a token offering, you sell these tokens to a large set of mostly retail investors in order to get some liquidity, some initial funding for your project. But the thing is, so this is, kind of token version of the crowdfunding model in Web2, which is not really that different, but except you're now taking advantage of the hypes in the crypto market and the eyeballs and the amount of speculation going on in the crypto market, right? So, but if you look at it from the project, from company's perspective, if I'm going to raise money for my company, okay, for example, the first route I'm gonna go to is to look for professional investors, meaning angels or VCs. I'm gonna look for those professional investors that do these investments all day long. Why? Because it's just easier for me. As a founder, it's way cheaper, way easier to deal with 5 investors on your cap table compared to like 5,000 little small retail investors on your cap table. Especially in crypto, a lot of retail investors, most retail investors, not most, actually everybody, are in crypto with a speculative motive, right? So if your token price goes down and you have like 5,000 people on your cap table, and some of them, they're not very educated, and your token price goes down, because I've heard like not a lot, but at least a decent amount of horror stories from Web3 founders. Like their token price goes down, and they get death threats from their retail investors and forcing them to, you son of a bitch, make your token price go up. I invest in your thing. You're just like calling them all kind of names, all right? So it's a tough world out there for founders. So at least if you deal with professional investors, that kind of customer service hassle is way less, all right? You sleep better at night as a founder. So if I can manage, I think if you look at from founders' incentive point of view, if you can manage, you will go to professional investors first, all right? If no takers, if you do not have any professional investors interested in you, then you look for alternatives. And one of the alternatives is crowdfunding. And one of the alternatives is, like in crypto, is ICO and IDO. In other words, you look at if it's a project that is good enough to be picked up by professional investors, if they can raise enough money from professional investors, why would you have any incentive to go to retail route, to go to the ICO route? Hey, so you gotta think from that perspective. That's one. I'm not saying this applies to every founder. Obviously, every project situation is different. Maybe you just have access to a bunch of retail investors for some reason, which most projects don't. That's an audience that you need to build up, right? And secondly, if you are able to actually build out that audience, I don't see why you are not able to actually get professional investors in the first place. Because one of the most severe challenges for most startups is distribution. It's how to get your initial customers, how to get more eyeballs on your product offerings, right? So if you can manage to do a successful crowdfunding campaign, either in a Web2 way or in a Web3 IDO way, that means you are already good at distribution. So given that, why didn't professional investors invest in you? All right. So some people will say, no, some project will tell you, oh, we are ideologically decentralized. We hate VCs. We hate angel investors. That's why we go straight to retail. Well, maybe what they're saying is true. Maybe it's just an excuse because they cannot raise funding. They did not manage to raise funding from professional investors because the expected return is not high enough. From the point of view of professional investors, okay? So there are a lot of VC bashing in the crypto world. Again, everybody is biased, right? We are all biased by our own backs. So I'm not saying you listen to anybody's words as a doctrine of truth, but you just listen to different people that will give you different perspectives, and you make a judgment yourself. Okay, so if you are able to crowdfund, that means at least you don't have a problem with distribution. Right? If you are good at distribution, most of VCs should be interested in you. Most professional investors should be interested in you. If they're not interested in you, there's some other problems. And one of the problems could be they don't see a business model or a way to make money, or at least make enough returns out of this. Okay, that's one of the reasons. So if professional investors do not see enough reasons to invest in the project because the expected return is not good enough, why would you, as a retail investor, invest in their IDO? So, given that you have less bandwidth to do due diligence compared to professional investors. So just think about these. Again, I'm not saying this is 100% applied to every project, but these are the things that you need to keep at the back of your mind, right? So if you see a project that's completely community funded, that did not have any professional investment at all, you gotta ask why. Sometimes it's because they're ideologically pure. They don't want any professional investment money. That can happen. But sometimes there are other reasons you gotta consider, right? And one of the reasons is just the project is shitty. Period. Next one from Anonymous. In some of these use cases, what is the advantage of using Web3? For example, the Netflix case, Netflix can create royalty tokens using Web2 and achieve the same thing. Okay, so what did I say about the Netflix example? Netflix, where's Netflix? Oh, okay. So what I wrote about Netflix is, okay, Netflix can airdrop Netflix tokens to users and let users stake tokens on pilot shows that they like, and then users can earn partial streaming revenue from those shows. So now users have more incentive to help promote their favorite shows, which will, help attract more subscribers for Netflix. All right, so that was the idea that I wrote down. Again, I'm not saying this is a brilliant idea. I'm not saying this could well be a shitty idea. It could well be that when you actually look into the details, you figure out there are XYZ aspects is totally infeasible. I'm just saying these are potential ways. And you can look at, I'm going to link this article. You can look at other examples, all right? Other potential ways that you can, just to give you a idea of how potentially businesses can leverage Web3, right? So the question is, if for this particular use case, why cannot Netflix just to create a database on their server and just, give people points like airline points or credit card points, record in their database, and then do the same thing. You don't need blockchain, you don't need tokens, right? Yes, that's true. But remember what we talked about? I think that was the last episode, if I remember correctly. The value of public blockchains is an open database for all the values that represented on this platform to talk to each other. That is the biggest part of, at least one of the biggest part of the value added of Web3 model is it's an internet of value. It's not just like one database of value that is sitting on one particular company's server. When you have an internet of values can easily exchange with each other. That's why you can enable secondary market trading and give liquidity to any kind of tokens, including utility tokens and loyalty point tokens. So that liquidity benefit is the huge driver. And the liquidity benefit is one of the huge factors that's driving the reflexivity of the crypto market. And because you can have these trading activities going on, and people, when they are holding a community token, for example, or they are holding the token of your liquidity programs, now they have more incentive to actually help you grow, because it gives them some kind of that means their the monetary value of their token goes up. So in the Netflix case, yes, the Netflix can create a user database on their server and do the same thing, but the thing is you're less able to actually trade those tokens, right? So with Web3, you if you have a show token, and it's like the trading will likely, the value goes up according to the popularity of the show, and then users can have more incentive to help you to promote those shows. That is one way that can leverage that reflexivity, right? Again, not the only way, maybe not, maybe this is a shitty way, I don't know, but just to give you an example. So with if you have a company database, there's harder for you to actually do that, right? Now Netflix is a big enough company, theoretically they can have their own marketplace for people to trade Netflix tokens, but it's way less powerful compared to an internet of values where you have one public blockchain platforms or several public blockchain platforms that are open access, tokens that exchange with each other, can trade with each other, can talk to each other. That is a very, very powerful mechanism to help drive growth, right? So you think of a Web2, each company, they can run their own incentive programs, but it's all in their own database. It's all fragmented. And actually this is not just a phenomenon with any kind of loyalty program. It's a phenomenon with everything, all the data, Look at healthcare, look at education database, look at a travel industry. All the databases are sitting in each individual companies. It's very rarely, because very rarely you have public databases from each different pockets of businesses or different pockets of economic sectors where they can talk to each other, because this is a tremendous coordination problem, right? In order to make all these different databases talk to each other. So there are companies who do that in Web2. One of the for example, a company like Zapier, it's a hub, it's an API hub for different companies' API to talk to each other, to connect different companies' API, so different applications can talk to each other, right? So I can achieve things like if you sign up for my email newsletter. By the way, sign up for my email list newsletter. It's tashalabs.com/newsletter. It's free, and I periodically publish things that help you become smarter about Web3. But that's a tangent. So if you sign up for my email list, and then Zapier sends a notification to my other application, which handles the email campaigns and record the user in the email campaign databases. So you allow different applications to talk to each other, but that is really heavy lifting, really hard to do still. It's a lot of hassle for different applications to even connect to a hub like that. And because of this very disparate, very different API standards and security standards of different applications. Now with Web3, with public blockchains, you have homogeneous or relatively homogeneous standards of how to publish tokens, which are representatives of values on chain. And how when you have like a homogeneous value standardized formats to publish this for this database, then tokens can talk to each other. Now when you have different public blockchain databases, now we are developing solutions for cross-chain messaging, for bridging, for those blockchains to talk to each other, so that on the application level, you don't really need to do much of anything to actually connect to the databases with other applications in order to allow for the Internet of Values to happen, right? So you that to me is a serious advantage of Web3, of the public blockchain platforms. Now, obviously, they're not performant. They're so slow. They're so shitty. There are all sorts of security concerns. And Web2 databases, they're fast, they're reliable because they're mature technology by now, right? So, but they do not have the openness. They do not have the composability which Web3 gives you from day one. Blockchain gives you from day one. So, with as tokens, as the Web3 technology continues to evolve, I hope, I think we are going to get more performance and more speed, but still preserve the open and composability and interoperability aspects, which is very hard to accomplish by Web2 platforms. Okay, so next question by Mike A. How are we doing on time? Okay, we have a little bit of time. Mike A's question is, when these ideas come into fruition, he means that the examples, ideas that I posted in this article, right? When these ideas come into fruition and adopted by large institutions, do you anticipate the companies to create their own blockchains, or will they build it on top of existing ones, such as Solana, Ethereum, or Avalanche, for example? Very good question. The answer is I don't know. I think it's a bit too early to tell. It could be both. It could be like one dominant solution gains more traction. Why is it too early to tell right now? Because both options are very bad. You have your own blockchain. It's still very slow, not very performant, and you need to have your own set of validators and so on and so forth. And if you go proof of stake, you have to maintain a certain security standards that's tied to the value of your tokens. Anyway, a bunch of issues. If you use one of the existing blockchains, they're slow, they're not performant. You get affected by other apps, activities that may degrade your performance if you have a token drop, or you have an application that suddenly gains popularity and you're sitting on the same blockchain as those, given that the total overall blockchain performance is not very strong. You get a lot of problems to be on the same chain as a lot of many other applications. So both these options are bad options. That's why I say I don't know. Too early to tell. It depends on which option evolves faster and evolves to become a more performant and user-friendly and lower the cost for projects and companies to deploy, right? So, for example, we just mentioned we have bridges and cross-chain messaging being developed. There are a lot of innovations going on in those. So if they get good, then it doesn't matter which chain you're on. You can be on the same chain and you can communicate with applications on other chains. And there are exchanges, token exchanges are sitting on multiple chains that can transact or exchange tokens across multiple chains. Those are being developed right now, right? If those protocols get mature, get good, it doesn't matter where you are. It can be on your you can be on your own chain and take advantage of the liquidity on other chains. Or and that is being on your own chain gives you more control, right? If you have like these are large public blockchains like this, for example, Solana, Ethereum, if they get very good, they get really very cheap to deploy, very easy to deploy, and very fast, while maintaining the same advantages they have right now. Then you can have more applications using those instead of having their own chain. So like for example, this week there are a bunch of hypes about this new chain called Aptos. That is being developed by a bunch of former Facebook DM people. It got hyped because there are huge VC investments behind. So they claim they will be able to have like a really really high transaction per second and so on and so forth. So I'm not saying they are going to, or that's the chain that's gonna get traction. I'm just saying an example. Like these new things just come out. It's an industry that's being innovated very fast, right? I think we are going to see multiple types of solution coming out. So long story short is I don't have the answer for this. I don't know if that's going to be built on one of the existing blockchains, or maybe there'll be a newer blockchains that are more performant than the existing ones, or projects going to be building their own chains. All possible, right? Too early to tell. Okay, so we are kind of running out of time, so unfortunately we are out of time to talk about investment personalities, but that is evergreen. It's not something time sensitive, so we can leave it to the next episode, and hopefully we get to those by next episode. So if you are listening on Apple, on Spotify, remember to give a good review for Tasha Labs podcast on those platforms. Thank you very much for that. And if you haven't, go sign up for my newsletter at tashalabs.com/newsletter. Okay, I'll talk to you next time.